Good evening. This is the Eye of the Storm podcast with the big picture update for the SPX, the NDX, the 30-year, 10-year, 5-year, 2-year notes, and the Treasuries, and gold and silver, and the dollar index. Today's date, Saturday, January the 21st, 2023. It was a wild finish to a kind of crazy week in the equity markets. And yesterday's expiration was what I would call throwing a wrench into the count, into what I was looking for and what I think a lot of other people were looking for. And now we want to take a look at it as how it fits within the big picture, what the market may or may not be telling us, and how does the market get itself into a situation which would appear that the entire marketplace has suddenly turned bullish and is pushing, as they did yesterday into that monthly options expiration. And that's where I really want to start today's podcast. I will go into greater detail with this when I do the Elliott Wave update tomorrow, which will specifically be targeted towards the NQ and the ES, which are the futures for the NASDAQ and the S&P. But beginning with that and what took place on Friday, and it not only took place in the equity markets, it was very selective in terms of which underlying stocks within the SPX and the NDX actually were in play in a very large way. And that's kind of where I want to draw and put this focus into perspective. When we really take a look at what took place and we take a look at the derivatives market, the explosive growth in the derivatives market and the participation of trading within that in the derivatives markets, particularly in options, has not necessarily thrown a wrench into how we work an Elliott Wave count, but it has expanded, detracted, and pushed individual characteristics and personalities of individual waves and limitations on waves a little bit in both directions. And what I mean by that is expectations for example, a particular wave can be overdone. Resistance and support can overshoot. And then the market turns and does exactly what you were expecting it to do. And why does that continue to happen? It truly revolves around how things line up within these individual companies that are components of these larger indexes. I'll start with the NASDAQ 100. In the NASDAQ 100, it is a capital weighted index. And therefore, as these companies gain more wealth, so to speak, for example, Apple, Amazon, Google, Intel, Metaverse, Microsoft, Micron, Netflix, NVIDIA, Tesla. These are large tech titan companies. And Tesla, maybe not, but Tesla is just a very large, considered, and a very heavily traded stock and options. And their weighting in these indexes, because of the value of the companies, has produced some wild swings. If there is any time when we're seeing that a market, particularly in one of these stocks, is being pushed towards a strike price, it is not necessarily revealing to us that the market or the players are becoming more bullish or bearish on a particular stock. It does tell us where the bigger players want to either squeeze or put this market so the expiration reflects what they need to get out of. Now, that might be considered whatever, conspiracy, it doesn't make any difference. I just see it happen time again, time again, time again, and time again. We saw it happen at the end of the year in the SPX, and that revolved around 38.50, or I believe many minute 38.75. One of those strikes had a very large short position, and I had heard that the short position was being held by JP Morgan. Now, whether or not that's the truth or who cares what it was being held with, it was also collared. So in other words, it's a collared in terms of risk up and down by large positions in the puts. Now, that strike price was the optimal place for that SPX to close and allow these options to expire, and it would have produced the maximum profit for those in that position. Now, as the market got close and near that, those that were watching saw that there was a very large shift in the calls, and that shift was getting out of the position, leaving the collar, which would have been, I believe it turned out to be a butterfly, in the puts. Now, how this happens or why it happens is not as important as what occurs as we approach those expiration days. Now, we have expirations basically within the SPX and the ES every day, Monday through Friday. Fridays are weekly. Then we have a Friday where it'll be the monthly expiration. So once a month, the third Friday of every month, the monthly expirations expire. Then we have quarterly, then we, et cetera, et cetera. So it has been built where volatility gets worked towards those positions and ceases to really reflect what the volatility is in the market, which can become confusing for traders. But here, if we're dealing just with these particular companies, they revolve around a strike price. And we can see through open interest and volumes where the bulk of these things are trading. Now, bring in the next phase, the next step. And that's going to be that we have very, very large firms that run algorithms. Everything is quantitative now. We know that. And so therefore, there are algorithms or quantitative trading that the algorithms scour, search all the different stocks, and they are looking for premium. So when trading options, it's going to be more prudent for traders to take advantage of premium. And premium can get pretty high when the market of an individual company or an index starts to really move substantially, one direction or the other. So again, if it's really zipping to the upside, the premium is going to be in the calls, where it gives people the right to purchase the underlying at a given price. And if the demand is to do that because everybody wants to get long this particular underlying, well, so the premium will rise. But if the perception is that we're looking towards a downside move, then we're going to see the premium shift and they're going to start paying up to get the put, which gives the holder the right to sell the underlying on or before the expiration date. So here we are coming into yesterday's monthly expiration. And when we took a look, or when I took a look, and I mentioned this for those that actually listen to the daily updates, I mentioned this on Thursday with terms to Apple, Amazon, Google, Meta, Microsoft, Tesla, and actually Netflix, because it came out with its earnings and the market loved them. The market absolutely loved them. So that gave a boost already to expectations of what the markets were going to do on Friday, particularly the NASDAQ, because we saw that they started to come in and buy Tesla and buy Apple. Why? Well, because of Netflix. So the gamma squeeze or the short squeeze or whatever you want to call it starts. Now, the reason I'm detailing this now is because so many of us continue to function on the bulls and the bears. And really, when you break it down, folks, when we're talking about the individual traders inside of these individual components of the indexes, there's nothing bullish or bearish about the trade. It's pure premium trade. It's a premium trade. And in essence, if you really pay attention, if a large firm is selling somebody a bunch of calls because they're capturing the premium, they're turning around and at the same time, at the same second that the sell order is filled, they're buying the underlying. Now, if they're just doing this on a delta neutral basis, and to say, for example, in Apple, it was the 140 call, and at the time it was building, Apple was not trading at 138. Apple was likely trading at 134 or 135. These positions start to build. They start taking out the premium. They're buying the underlying. And if they're doing a delta neutral, they're not buying it one-to-one with that option. So in other words, that option may have had a 45 or a 50 delta coming in to the week last week, but that delta started to grow as the market got closer to 140, when the market really started to rally on Thursday, Wednesday, and Thursday. So that puts on what we would then call a gamma squeeze. So if you understand these Greeks and how they are used and what they represent, you're going to get a better understanding of what's happening in what we would call a short squeeze, or just a squeeze. They're squeezing the bulls, they're squeezing the bears, et cetera, et cetera. But understand that these positions are often being put on, excuse me, without a directional bias, because they're hedged immediately. And if they're hedged one-to-one, in other words, not delta neutral, but you buy one call, you buy or sell 100 shares of stock, that's a done deal. That's a done trade. Your purchase is that price that you just paid for the option at that strike, and you're selling, you're covering that position. It's hedged. It's hedged. And there are ways to actually now put on the other side, right? Because if you learn options, every call is a put and every put is a call. I don't want to take the time right now to go into that explanation, but understand that when you're buying the call, if you don't sell the stock, you're also buying the put. So again, if we look at it the way it's actually happening, then we're not going to get caught up in the markets being bullish or the markets being bearish. We're going to begin to realize what is going on. And it isn't that everyone is changing their mind from Thursday, when we saw Wednesday and Thursday, where we saw the markets decline, the equity markets very substantially. Then suddenly Thursday, they just do a massive rally. And here's the other very important point to add to what took place on Friday: the volumes. There was this very strong absence of sellers at any level in these futures markets, which was very clearly pointing towards the same folks that have these large positions are pushing because they're closing those positions versus trying to balance it out with selling. And so they didn't need to create another short. So they didn't. And the market just went up. Basically, in the absence of selling, it was free for all. And if you needed futures, you got stuck, because the trade could have been totaled by what took place in the futures market or what took place in the underlying of the stock. Now, I'm telling you this because what I attempt to do, I'm an ex-market maker, an options market maker. I fully understand being bullish or bearish or directional in a market, because that's really basically how I built my positions. But in today's markets, because there are so many derivatives and they are so massively traded, directionally can get interrupted. by an expiration and what needs to be done for that expiration. It doesn't necessarily change the overall picture. Now, bear that in mind as I begin to talk about the SPX and the NDX and move on with this big picture update. The other market that actually was extremely volatile last week against its counterparts was the 30-year bond. It was extremely volatile, up and down and every which way, as it prepared for its expiration on Friday. When I took it in comparison to the 10-year note or the 5-year note, the 30 moved much faster and much broader in a range than the others. So the closest comparison I could make would be the 10-year note. And you'll see that the yield of the bond, 30-year, shifted around a lot more and ended in a much different range than where the others ended up closing on the week, basically unchanged from the prior week. Okay, big picture update. Starting here with the SPX, as you can see, I'm using the line chart because we need to see very clearly, and I'll show you the difference. I want to be very clear on what the heck is going on and where that, when we look at the other one, brings that 2 to here. Instead of at the other place where we saw, well, let me just show you. Here we have a high at 41, almost 41.01. Here we have a high at 41.51. So basically it's flat, but it slightly broke it. Now, when I move it down to a line chart, which again, in case you're wondering, a line chart's going to be on a closed basis. So where the bars close is going to be what will produce the chart. If I put it on a closed basis, we can see that the market topped there at 40.80, even though there was a surge that took it up an additional 20 points. The close brought it back down into this level. Now, intraday Fibonacci's, yes, I want to see that extreme high. I want to see the extreme low. I want to see the extremes that a candle will do because it's going to help my day trading. But in terms of working in Elliott on a daily, what's the chart telling us? I use the line chart when it looks confusing. So again, here we're in that primary C wave down. We have completed waves, intermediate waves 1 and 2. And I take a look here again at wave 1 finishing here. Not here, but here in mid-October. Then what do we have is a 5-wave sequence up for wave A, a decline, which was wave B, and then another 5-wave sequence up for wave C to complete wave 2. Off of that level, it was way up here when we look at the candle. And if we remember correctly, on the 13th of December, I believe it was the CPI. Whoop, and then down. Whoop, and then way down. So I took out that extreme. Now what's it look like? 1, 2, 3, 4, 5. If I can get 5 waves down, I label it minor wave 1 of intermediate wave 3. Now I've taken it all off, but I want to show it. And then what do I have here? A, B, or actually A, B, C, minor wave 2. Now, granted, on a daily chart, it's a little bit more difficult because we can't see any of the internals. It just ended up down. But if I'm going to put minute wave 1, this still can be minute wave 2. In fact, the market can, on a closed basis, pop above 4,000 or get up to 4,000, because what the rule states is that a wave 2 cannot exceed the starting point for wave 1. And on a closed basis, that's going to be 4,003 or almost 4,004. When I take it over to the candle chart, it doesn't give me a whole lot more, but what I have is 4,018. Now, this was hands down, folks. It's a very bullish bar on the weekly, excuse me, on the daily chart. A very bullish bar. Clipped and caught. The 4 and the 8 are moving up. The 20s flat against this extreme rally we saw. Look at the 50, look at the 20. Flat, flat. 20 angling slightly. I can bring down to the 4-hour chart. Let's get a little bit different picture of what we got going on. Again, 1, 2, 3, 4, 5. Minor wave 1. All this ABC entanglement. And then we're in that C wave. If I go back to that line chart here, let's take a look and see what that looks like. Here again, we show that very difficult ABC x ABC, and now here's the C wave. Even if we're doing it, even if we're here, and we've got to declare that low here, or 1, 2, and they got a 1, 2, 1, 2, 3, 4, 5, or 3, 4, 5. We could be in. Now, here's the kick. If I look at the line chart on the 4-hour, we do have the possibility. We do have the possibility where we're counting up in that C wave, we could be done with it and put the minor 2 there, or we may still have one more new high to make. Now, again, going over, this is basis the cash market. So back going over here, if I'm going to put the minor 1 here, A, B, C, is that A? A, B, C, is that B? Or is this A, you know, it's a difficult count, even in the cash, as to what essentially it did. So let me go down to the hourly chart now and just let's take a peek on what's inside, and that's going to be all over here. There's our low for minor wave 1. Pretty sure that's going to be our low for minor wave. Let me just check that date. And that's going to be on December the 22nd. Let me go back over to the 4-hour, and let's go back to see what we have. And that's on December the 22nd. So yes, that low is what I'm going to be working off of to figure out where are we. So right there, back there, we're on that low. And here we have, is it? Sorry, I just want to be correct on this. Let me go back over. And this low is 61, and this low is 76, and 64. Yeah, okay, it is. Thank you for bearing with me, because I like to be exact. So now we're trying to count out an ABC up. And so it seems that we might have it up to here, and then we have a corrective down at X, and then an A and a B, and now we're in. But even if I don't do it that way, even if I'm considering this A and this ABCB with a slight irregular on that, I'm not sure what happened on the 3rd, just the start of the new year. We had some reason to just pop this thing as it did, and then it collapsed at the same time. So I could, again, if I bring it over and I take a look at the line chart, there you go. A, B, C, A, B. Now we're into that start of the C wave. So it ends up here, if I'm looking at it, not necessarily this double or triple ABC as it was presenting itself on the candlestick chart. So if I take all the extremes out of the market, I can get an ABC A, B, 1, 2, 3, 4. Well, this is going to be tough, because you're going to try to get 1, 2, 3, 4, 5, 1, 2, and that doesn't work. So if this is 1, this is 2, this has to be 3, and this is 4, and this is 5. That still is the way that I am counting it. So again, A, B, C, X, A, B, and now we're in that C wave. So it is a double. A, B, C, X, A, B, 1, 2, 3, 4, Now, there are some that might consider that this, what is that then, is a 4? That would have to turn into, and I did try to work this out, an expanding diagonal for wave C. Possible? Yes. But we would be looking at it being still a 1, 2, 3, 4, 5, and there would have to be 1, 2, 3, this would have to be 4, and I just don't see the diagonal portion of it, which tends to keep me at my previous count. Minor wave 2 done. 1, 2. Now, what happens if we do go up? Well, we can go. Remember that Elliott observed and left us with that wonderful guideline that wave 2 can retrace nearly 100% of wave 1. Very often, the personality or the characteristics of a second wave is the next. It's the last opportunity to buy off the low of what they're considering that to be. For whatever reason, now people want a place on that. They'll come up with a reason as to why we should continue, and we may. The Nasdaq's in a little bit different position. The Nasdaq could go up and just push itself above that previous high, not necessarily against the minor wave 2 high, excuse me, the intermediate wave 2 high, but against the minor, they could, which would change this minor 2. This is the minor 2 high, and it would change that. Let me just go back and make sure that I'm not talking off the top of my head. Right. This would be minor 1, minor 2. So the minor 2 high is the one that could shift. And that would be, we just need to allow for a larger move here. In fact, it could be 1, 2, and this is all 1, 2, 3. And this is within this third wave. And then the third wave actually ends here, and that's the 4, or the third wave ends here, and that's the 4. It can be very complicated. I'm not sure yet. I have to let the market tell me, and the market threw us a curveball on Friday. So this is just a difficulty. And again, just to add to the trading side of it, this is precisely why, because of the nature of algorithmic trading, one of the effects that I've seen is these sudden shifts in direction and just going solidly in one direction on an expiration. Now that interrupts if you were having downside trades on. It just absolutely destroys them, and you're going to have to decide, what do I do? Do I get out? Do I not get out? Do I reverse? Do I not reverse? If you're trading long term, if you're putting on a position based on a long-term count, this one, intermediate wave 2 in its place, then you have to be okay with these jimmies around. If you're playing this play down, then yes. But here's my answer to how people need to make decisions. I set a set of rules. The rules are, the first one, what's your trigger for the trade? So what's your entry? So what's your trigger? So that's the reason that you're going to get in that entry, you're going to get in this trade. So what's going to trigger and where that entry price is? Second, what is the goal of the trade? So that's going to produce your exit. What are you looking to make on the trade? What are you thinking it's going to do? If you're in because it broke one moving average, you're looking to move to the next moving average, or you're looking for a wave 3, and this is its starting point, and you've got an estimate as to where it's going to complete. You can then figure where your exit is. But the most important is, and this is the one that people don't put into the market or just glaze over or allow the market to walk over it. You must determine where that trade becomes invalidated because what you have it on for is not happening. That's your stop. And people have a tendency, or traders have a tendency, not to honor the third part. And when that happens, what normally can take over, now you're getting angry because the trade's going against you. Now you're kind of getting upset. You're losing money. And now you're going to, it's a natural tendency to go like, oh, that, the Elliott wave doesn't work. This doesn't work. That doesn't work. It's like, well, that's just disrupting you because you're still in the trade. If you trade with a solid mindset, you're going to have your entry, your target, and your exit already planned. And the stop has to be unmovable. That's how you protect your capital, how you protect your trade, how you keep your mindset in place. But the volatility and the moves, folks, is what I decided that was going to be much better for me to trade day trading. I continually tell you that I do not take a directional bias. I'm not bullish. I'm not bearish. Go ahead, market, do whatever you want. But I will talk about the Elliott wave. And again, when I'm presenting this big picture update, that yes, we were waiting for the completion of the intermediate wave 2. We were waiting for the completion of the minor wave 2. We got the minor wave 2 completion on an Elliott basis. So as the market turned lower, that's when you put on your position to carry you through minor wave 3. When you put that position on, you had your trigger, you had your guide to take it to where you think it should go, and those were through fib levels that I gave or that you produced yourself. But if you walked past and did not employ the third part, then you got to be comfortable with what the market's doing right now. Third part's in place. And if it's in that, let's say your break even, where you got in, you'll get out. Okay, you didn't make any money, but you're not losing any. If you got in a little bit late, then you need to just pick that point where you're going to get out so that you're not just sitting there fuming over the market not doing what it should or doing what they thought or I thought or anybody else thought. So honoring your own trading rules is going to be vital for us to get through what quantitative trading and algorithmic trading has produced in expanding, decreasing, realigning some of the rules and some of the guidelines that Elliott provides. Now, that doesn't mean that Elliott does not work. It is showing, it's just all the way down, folks. If you've stuck with me and you've followed me, every long-term move has kicked in and is following through. We can't get hung up on this if you're trading longer term. If you were day trading there, yes, you needed to make your adjustments. In fact, what I do when I notice this and I go over and I look at the volumes and I see the volumes are light and there's just buyer after buyer after buyer and they're just taking it higher, my guess is join them. I'm not going to fight them. I don't care if I have in my mind we're finishing up a small minute wave 2 and then a minor wave, and then the minute 3 within minor 3 should start to kick in. That's still actually the count. I will give tomorrow where I think if it goes beyond, but on the cash market and even on the futures market, it has not broken anything yet. So enough with that. I've got to get going so I can finish up our weekly update. But that's the trading part that I really want to make clear. And if you have any questions, please feel free to write in the comments. I will answer. I will talk about it with you. Now, so what can we expect from here? I'm going to go back out to this daily so I can see. I am going to leave this as minor wave 1. In fact, I will put it back on, minor wave 1 and minor wave 2. And minor wave 2, if it comes up and it breaks it, then minor wave 2 is the one that likely still has to go a little bit higher. Then what are we looking at? I go back over to the candles. On here, as far as the future is concerned, we have gotten up. We have gotten up to here. We were up at, oh, Lord, I can't remember. Let me just quickly go over so I can show you. On this minor 2, we got up to 4,042. And that was a resistance area. So again, what now? I'm putting it together for tomorrow's update. But if I'd marked that, and this is 1 and this is 2, what the change might be is that was actually 3 at there, and this is 4, and now we're still going to go up and go a little bit higher than 40.43 up to that 40.60 area-ish. But where we can't go up above, that's what we can't go above, 41.80 if I'm using the candle. So same deal if I come over here. Where can't it go above? That's where it can't go above. If it's still within the minor 2, it can't go above 41. At the high is 4,100.51. That's the cash market. Can't go above that. If it does, it's not a wave 2. Then we're looking at this wave being expanded. But do I think that this is going to gain enough steam and get itself above there? I don't know. Whatever the algorithms are going to start pushing on, but I don't think so, because if I have to balance my big picture out against what's happening on the economic side, what's happening on the fundamental side, what's happening within these companies, why would they push Google up $5 when Google is the latest one to come out and say, by the way, we're laying off 12,000 people for the same reason Microsoft did, for the same reason Metaverse did, for the same reason that all the others have cut them off. We are possibly heading into a recession. Why are we buying the market? Because somebody's got this idea. It's like, well, inflation's dead. They forgot the second part of that. If inflation is dead because we're heading into recession, what comes next? Deflation. Assets will deflate. Companies won't make as much. Doesn't mean they're bad. Just means that's the reality of the economic situation. Now, I'm not going to jump up and down and say, I'm wrong, because this is absolutely 100% in my mind corrective. And this, as we saw on the closing basis, a clean 5 down. 1, 2, 3, 4, 5. So I can't necessarily figure out how would I turn that into an ABC. I probably could, A, B, and that's the C, which gives me one more shot. But even if I'm counting all of this, it's overlapping. Big overlapping. 4 overlaps 1. Big overlapping to make it work. That's why I keep it just the same and let the market tell me. And it will. Now, how do we trade that? I just explained, and I'll do it again tomorrow, so make sure that you're listening on that one too. Moving over to the, and by the way, the 200 here on the daily and the SPX, the 200 EMA still flat as a pancake. The 50 flat, the 20 flat against that pretty strong rally we had on Friday. So daily chart's not that excited about it. We have resistance just at or just below that high. We may try to go up and touch it. I don't know what the follow-through is going to be. I saw them still coming in after hours to try to cover coming out of that, out of the expiration. But again, we have to wait. Over in the NDX, believe it or not, it truly is pretty much the same ordeal. But here I'm leaving because this is even a cleaner 1, 2, 3, 4, 5. Cleaner 5 waves down. Not so though if I put it over onto the candle. We get all this noise. But here, the noise is gone. I probably should move the 2 and put it here. In fact, I should, and I forgot to do that. So please forgive me while I move the 2. Even with that higher high that we saw, I'm going to move it over to here. Because the closing basis, it was all the way down there. Minor 1, A, B, and we're in the C wave. If I bring this down and let's look at it at the hourly, A, B, 1, 2, it could be that's the third. Here's the 4. And now we're in a 5, and the 5 will go up and break back above 11,700. Now, if we're going to keep it for the NDX on the cash market, and we're going to look at possibilities for a wave 5, then I'm going to include from this low to that high to this low, and we have basically 11,696. Now, if I go over and I move it back to the candle chart, the same number. So what we have on the cash market is 11,688. We know on the futures market it was above 11,700. So, but cash-wise, didn't make it. But even if I was to do this, right? 1, 2, 3, 4, 5, okay. 11,696, or call 11,700. But even if this fifth wave, if indeed that's what it is, once it cruise up here, there's what it would equal, the third. So the numbers shift a little bit if I have to move this down, which I probably should, and up to here. In fact, I will. Let me get rid of this. And we're going to go from here to here to here. So a little bit different. We got 11,702, 11,754. That's if this is 1, 2, 3. As you can see, I moved everything over. I put the ABC A, ABC B, and then put the C wave up here. And that would be the 4. And that's the, excuse me, the 3, the 4, and we're in the 5. Look for a little bit higher on Monday to finish it. And so the longer term picture, again, here's the real kicker. It's not changing. It's not like, oh my God, everybody's getting bullish. Now we're just going to go, 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 go. No, that's not, in my opinion, what's going to be happening. I think the longer term picture is holding firm in terms of we're not entering into a new bull market, for lack of a better word, a new up phase. We're not entering into where interest rates are going to decrease. No, they are not. Now, yields might come down because the bond markets, as you'll see in a moment, are going through their own ABC. And the B part of it is suggesting higher bond prices, lower yields. Now, where it sits in all that, yet to be determined, but I'm going to talk about that in a minute. Here in the NDX, we have that chance. But if I pull it back out to the big picture, folks, it's just going to put in, again, that minor wave 2. I do not see the market jumping above 12,000 here. If they continue to just push, I will figure it out, but I just don't see any reason why they would do that, even if premium suddenly changes. And that's what the positions would call for. If they come in on Monday and on very heavy volume buy it, then yes, it's going to change the picture. But that was not heavy volume on Friday. It was not. And that's, I think, we got to put into what we consider. All right, so that's going to be it. Again, daily 200 in the cash is sitting at 12,096. The 50s is flat. The 20 has not broken above the 50. The only thing that has is the 4 and the 8. And the 50 ceased going down and just got flat against that massive rally we had. You can see that. It won't take anything if they just turn around and start kicking the crap out of the market for this to flip and that to flip and that to just head and then everything got to go back down. Getting excited about that means to me, take a step back Trade what's in front of you. You don't want to lose money. The objective is to make money. Even if you're trading options, you could trade options on Friday and just got in and made $2 or $3 on a lot of these stocks because their turns and their flips were massive. So again, becoming more fluid or liquid in how you want to trade it. Now, if you're a swing trader, yes, you got to jump in and make some changes. If you're a long-term position trader, don't necessarily have to change your position. In fact, you might want to add to it. The longer-term prognosis is continues that we should continue to drop down. So if you're trading it to that, I don't see why you'd want to change it. Flipping over quickly, let's go to the bonds. In the bond market, we are continuing to do an ABC up. This was the first initial 5 waves down. And the absolute high for the yields right now off of this low is 4.4. And that's on the 30-year bond. Now, let me go back out and I can show you, if we go here, you can see on the 20th, we actually went up a little bit week over week, and we closed at 3.66% on Friday, but it was very, very volatile. So I think what we're doing on the 30-year bond is, again, if this was the end of 5 and this is like 1, 2, 3, this could have been a 4, or this is ABC and this is all a B, or this is just the A of B, this is the B of B, and we come swinging back down before we actually go up, because I'm still expecting another leg up to complete the larger ABC, which has been in force for quite some time. And let me just go to the weekly chart and we can see it clearly. Oh, come on, damn it. Sorry, I know I'm trying to rush and it's not going to work. So what we got going on, first 5 down, here we got the A, that could be the A, B, and we swing back down again. If I take it over to here, you're going to see what that volatility did. If I take the volatility out, you're going to see that it basically still could be the A wave, could be the A of B, the B of B, and we do turn lower, following through on what we started to back off on Friday. That could continue and bring the market back down. If not, then this is A, this is B, and we're in the C wave up. And if we're in the C wave up, what could have be going on in that respect? 1, 2. So if that's the case, the next move is going to be a very strong rally up, and yields. This is the part that gets a little confusing, because we can take a look at the yield chart and we're seeing, I need a little bit more in this 4th wave. Now, to me, the yields are presenting us with a little bit different of a count, because the best I can do, this is only 3. This is 3 up. So it's just going to be a 4 and then a 5. And then we do a stronger ABC down. So when I try to put the yield chart next to the price chart with the bond, presenting a little bit of a different picture. So both are basically saying, well, we still have some room for bond prices to go up, yields to go down before we do another run up, or we're going to go and do that run up now. So in other words, this being 1, 2, 3, 4, 5 to be wave A on the yield chart, which should still be in wave A on the price chart. And then we get that internal B wave and then finish it with another 5 up to do an ABC. And that is where yields will then go much higher. Then we're looking here 6.5, maybe even on the 30-year bond, possibility of up to 8. Now, over in the 10-year note, didn't have quite as an exciting week. Week over week, we moved 1/10. actually 1/100th of a percent. On the 13th, we closed the week out at 3.49%. And on Friday, we were at 3.48%. So here again, looks like, it's an ABC. And again, this is my monthly max. Let me start bringing this down. There's the low. Interesting. If I look here, 1, 2, 3, 4. Wow, could that have finished the 5? We're going to put the A there, and now we're in the B wave. So you can see that now we're not even going neck and neck between our 30 and our 10-year note, which are the most correlated, which because of the activity that was going on in the 30-year bond was incredible. Incredible volatility, and the intraday moves in the 30-year bond last week were like rocking my world. I was like, wow. And so I've set up a pairs trader, which is going to go, the 30-year using the 10, and the 30 was moving way faster, which makes the spread work like a charm. And so there was a lot of money to be made with very little risk. Now, here again in the 10-year, it could be just 1, 2, 3, 4, 5. Maybe have we finished the 5? Do we need to do one more? Rise up, maybe getting back up and touching or slightly exceeding where the 200, which is sitting pretty much right there at 116.120. Maybe we just get above that, gets right above that resistance. We get a little above that. Finish this 1, 2, 3, 4, 5. Mark it as wave A. Start to come back down in a B wave. We're not going to be looking for exceeding that low, which if I take you back out to my maximum monthly, you can see on October the 24th, the 10-year note got as high as 4.25. And so that's the high yield that we've gotten so far. And now we're back at 3.5 up in here. Now, would that suggest, when I bring it back down again to that daily chart, what that suggests, we zip back up to a little bit higher, like 3.9, 3.7, maybe even back up to 4, and then and then zip back down where the yield will start coming back and maybe down to 3.25, maybe 3.5, 3.25 on it, even further. So we might zip up and then zip back. And here in the price of the 10-year note, that would suggest here we're going to get back up above 3.5. Again, let me go back out so I can just show you what I'm talking about, because I put that all on this chart. We'd be talking like we're going to get down. We have not really gotten down, so I'm thinking that we're just going to hang around 3.5 as far as the yield. But the price of the bond will fluctuate a little bit, maybe getting back up to here. So maybe back solidly around that 3.5, but I would think maybe we don't go too far before we put in 1, 2, 3, 4, 5, put in for wave A, put in that B wave, end up back down here, which is going to be closer to 4. Okay, now the others are basically also doing the same thing. And so we have all of them coming in, but here I'm trying to just figure out where we could go with this. And I think actually right there, 110, 197 on the 5-year. And again, when I bring it out to here, we're not looking for much. We already have seen 4.45 in terms of where this low came in. And so far within here, we're just working through this ABC. So we finished on Friday at 3.6. If we go back up to there, we're not really talking a whole lot of a move, except back to like a little bit higher, 3.61, et cetera, where this would come in. Then we here as well need to do a little bit more of a correction, and then another, as far as this is concerned, this finishes, and then we nosedive back down, putting in another large drop. But the 5-year is going to get, it's going to get funky. So I'm not sure what you're playing on these, but here, this is also good. If we continue to rise up a little bit, we might get back up towards 420 down and downside. But I think that in terms of the price, as we start to head higher, we will get back towards maybe 3.75, maybe 3.8. I'm not sure. I'd have to really look at some rates, but that's the 2-year. And I expect the 2-year to continue to climb. Now, over in gold, let me get over this, because I'm going to have to kind of pick it up a little bit, because I am going to be doing a particular podcast right after this one with my friend Dan Ascani, who is a master in gold and also one of my teachers of Elliott Wave. And we're going to be going over gold in a deflationary economy today. And then we'll have part 2, which will be tapping the power of gold. And so those are to be coming. Now, in gold, the rally has picked up. There are many reasons for the rally to continue. And so it's not going to show me what I really want to see. If I look at it on the daily chart, you can see it's very, very nice. We're getting 3 down, then we start to work on 5 up. It pulled back a little bit on Friday because it was like against what the market was doing. It just kind of fell in. But I think next step, we're going to get to 1953. We'll break it, and we will start heading to 2000. That is my anticipation before this total rally really pulls back in a little bit stronger way. I think we get up closer to 2000. Silver, the laggard out of the whole picture, truly is, continues to be. We're just jamming back and forth in a tight range. I do think silver's going to follow and break out again and end up heading up towards at least 29, but it's got to get itself up probably above that high before we do a more substantial pullback. So I'm looking for silver to continue to go too. It's just being very stubborn. And then finally, over in the dollar index, that has really become pretty bizarre for me, because you can see I've not really done a count, so I want to do some checking on what all this is, but I flipped the count around just a little bit to make this look like, is that the possibility that this was the 5? And if it is done 5 up, it's kind of ugly. This is kind of weird. I'd have to go and look. So I'm not sure, other than I can tell you that this is where we should continue to find support if it starts to drop. It's dropped right around the 100 level at 99.4, 99.05. I'm going to call it on the downside. We got the 200 at 98.57. So, but there's still a lot of pressure. Now, whether that stops and whether it's relieved, yet to be seen. But I'm not real happy with the count, so I'm not going to stand real strong on this dollar right now. I need to really refine the count and work it against what is happening. So I'm going to leave it all right there. More important today, I wanted to really discuss the equity markets and how we're trading them and what we need to kind of maybe make adjustments to. I want to thank you all for listening today, and please do stand by for the balance, which will be the next podcast that'll be put up hopefully tomorrow.